Hello and welcome everyone to another episode of Pro Perspective, the insider's look at all things commercial real estate. I'm your host, Giannis Papadakis, Business Development Manager at Crexi in our auction department. And today we are zoomed in with Branson, Blackburn, and Matt Davis of Trinity Real Estate Investment Services. For those of you who don't know, Branson, Blackburn, and Matt Davis are two of the founding partners of Trinity Real Estate Investment Services, a Fort Worth, Texas-based commercial real estate brokerage focused specifically on single tenant net leased assets nationwide. Founded back in 2017, Trinity has surpassed $1 billion in closed transaction volume across 38 states and was named a 2019 Net Lease Firm of the Year by Globe Street. Wow. Now, in terms of Dollar General, today we are talking about Dollar General. We're looking at their transaction history. 107 Dollar Generals closed in 2019, with 135 Dollar Generals closed year to date in 2020 and another 28 in escrow. Wow. Branson, Matt, welcome.
Thank you. Thanks for having us.
Yeah. Tell me, let's get started. Before we jump right in, there is a Q&A feature to this Zoom call. If you have questions, please submit them to the Q&A. There is also a chat feature. Please go ahead and submit any questions you have for our panelists, and I will try to get to them throughout the program. If we don't get to your specific question, stay tuned and we will be sharing some contact information. You can reach out directly to Matt and Branson. So, Matt, let's start with you. Let's talk about first kind of your pathway into commercial real estate. How did you get started in commercial real estate, and how did you enter the net lease space?
Yeah, so I guess I would say I had a very non-traditional kind of path. In around 2015, I was working as a young adults pastor for a pretty big church in Texas, and wanted to get back into kind of the business world of things, and had some family connections who were just in residential real estate, and had a connection with Branson's team at the time. So I got introduced to Branson and his team in 2015 or 2016, and was initially starting in a West Texas office kind of by myself, and was getting started there, but really enjoyed the concept of working with the team, really enjoyed the concept of working with other people. So shortly after that, kind of hitched my wagon with Branson to kind of learn from the business. He was kind of in a different stage where he was transitioning from a couple product types. So I kind of went in as someone to learn with him, learn from him, and we started working together in 2016. And he and I have been kind of joined at the hip since then. Some might say unfortunately, but it's worked out. It's worked out pretty well for us. And then I'll let kind of him talk about from that team to where we are now with Trinity.
Yeah, and Branson, I'll pose it to you. Tell us a little bit about how you got started in commercial real estate. Did you have that sweet facial hair when you started in commercial real estate, or is that a recent addition?
Well, I'm on the wagon with you doing No Shave November. I haven't gone down to just the stash yet, but that might be the final touch at the end of the month. We'll see.
That's the final move. That's the
final move. Man, when I got started commercial real estate in 2011. Initially got into apartments. Every investment book I read said people graduate from owning houses to apartment complexes, so that was enticing, and I wanted to be a broker, learn everything about them. Got into that space, learned that I did not enjoy the apartment space, did not enjoy all the site tours and coordinating with management companies, and just wasn't my cup of tea. And had a broker that introduced us to the net lease space at that time. And so in 2013, shifted into the net lease space, and specifically chose Dollar Generals to focus on. So just started cold calling and hammering those across the country, and that evolved over time, and starting to work with some developers in 2015 and growing from there. And Matt, Matt coming on board, as well as the addition of many other team members and starting Trinity in 2017.
Wow. So you dove right into Dollar General at the get-go.
Yes. So, I was young and naive at the time. And so I looked at it, saw Dollar General was a large company and they had some of the highest cap rates. And I thought high returns were good. And there's a lot of them across the country. So might as well focus on that. And it's turned into to be a blessing.
Yeah. I mean, that decision seems like it's probably paying dividends right now with the popularity of the tenant in the net lease marketplace. And before we, sink our teeth all the way into Dollar General, why don't you tell me a little bit about some of the standout net lease trends that you've seen over the last few years?
I feel like in general, net lease has just been a constantly growing marketplace. More and more investors have become, educated on the space and wanted to transition out of assets that require more time and management into the passive investments that net lease has to offer. So I just feel like it's been growing. Cap rates, debt rates have continued to compress, and through that, cap rates have continued to compress for the most part over the last 5+ years. And so it's been a good space to be in, and just continue to see grow.
And Matt, I'll pose it to you. What businesses are seeing the most traction right now, the least? Give us like a meta snapshot of what you're seeing.
Yeah. So, I mean, I think the topic of our conversation today being Dollar General is probably one of the hot ticket tenants right now. I think we'll get into kind of the whys down the road, but I think ultimately people right now are being cautious, and Dollar General has been a tenant that's done very well, I think, from multiple angles. I think if you look when COVID kind of came into the picture, in March or so, a lot of businesses took massive hits across the board, whether it's stock market price or whatever, and I think you saw Dollar General continue to weather that storm. At first they had a little bit of a dip. I think their stock went down 15-20 points, but shortly thereafter it started to come back before anybody else came back. Their price was at or near a 52-week high really early on, even in April and May when things were still really bad across the country. So I would say, just from the COVID standpoint, I would say Dollar General, that's kind of where our eyes are, where our focus is, has done really well. I think there's some other tenants that people have seen as essential businesses, have been deemed essential businesses as well. But for the sake of this, for this conversation, I do think Dollar General has been probably one of the hottest tenants in the net lease space over the past 5-6 months.
And what makes Dollar General and similar net lease tenants so resilient during challenging economic times?
Yeah, I mean, I think it varies. I don't think you can say that for all net lease tenants. I think there are a lot of net lease tenants who were and still are struggling, whether it's because of the 4 shutdowns, whether it's for the fast food restaurants, the casual restaurants who were being forced to only use drive-through. I think a lot of those tenants struggled for even making rent payments. So I think, once again, honing on Dollar General or other essential businesses, I think it's a product of people still needing supplies, people still needing the items that maybe they don't want to walk into a Walmart with thousands of other people. Dollar General offers an alternative to where they can kind of hop in, hop out rather quickly. And then some of the other essential businesses, I think, have created confidence in the investor to know they're going to get rent. Whereas maybe when they were in multifamily, I don't think rent checks were coming in as fast as they were from a lot of the blue chip kind of single tenant net lease tenants.
Right. Now, there is a distinction to be made in some of the Dollar General leases that are out there in the marketplace today. And Branson, could you talk a little bit about the difference between some of these, newly constructed 15-year triple net leases versus some of the, older double net Dollar Generals that you see?
Yeah, to simplistically sum it up, Dollar General's lease has evolved over time. So, from their leases signed in the late 1990s and early 2000s, they signed, for the most part, 10-year double net leases that had roof structure, HVAC expenses over $750, all as landlord responsibilities, and made CAM payments for parking lot maintenance, etc. And then in 2009, 2010, they evolved to a 15-year double net lease. So their primary term became 15 years, but roof and structure were still landlord responsibilities. And then in 2011 and beyond, they went to the 15-year absolute triple net. And maybe like 2011 through 2014, maybe even 2015, they had a 3% bump in year 11. And then after that, it's just become 15 years flat for the primary term. So it's kind of been the history behind their lease evolution.
And do you find that there is a different desirability for both of those lease structures?
I think there's different yields associated with it. One of them, requires management and time, and they're shorter leases out of the gate. And so with that comes higher yield and higher return. And so there's a buyer profile and a buyer group that love those assets, and that's what they focus on. And then there's a buyer group that loves 100% passive income and longer term 15-year leases, and they're willing to accept a lower rate of return in order to get that. So they're definitely two different buying profiles, both of which are very active.
Got it. We've got a great question here from one of our participants. Troy asks, talk about the dynamics of the shorter remaining term leases. What are the key data points to consider? What are the red flags of properties to be avoided?
And is this relating to Dollar Generals, Yanni?
Yeah, why don't we keep it to Dollar General?
Yeah. Okay. So yeah, that's a good question. I think that's something, and that's really specifically to double net deals, I would say, because most of the 15-year absolutes, whether it's 2015, those are still going to have, 9+ years of term on them. So I'm going to make an assumption that it's one of the older double net stores. So I think there are multiple things you look at. That's one of the big questions we get is, I'd buy this, but I need to know if they're going to renew. And, I think you could make a lot of money if you knew every single dollar store was or was not going to renew. It'd be really simple. So one of the things we talk to our clients when we're working with them to acquire some of these older ones that have shorter term is the store footprint kind of Dollar General's current prototype. There's a lot of the older buildings that Branson mentioned in the late 90s, early 2000s. The square footage was different than it is today, and just the kind of the general layout of the stores was different. So that's something we look at is, okay, is this a store that kind of fits the current prototype? That's always a good indication. It's not always kind of 100%, but it's one of the things you look at. Obviously, trying to find out store performance is important. Once again, another one of the lease nuances in the older stores was a percentage rent clause. So a lot of the older stores had a clause in the lease where Dollar General was required to report annual sales. So that's a really good point if those things are still in there. A lot of those leases were modified and that clause was removed. So unfortunately, you don't have that information. So you try to acquire that other channels, whether that's talking to store manager or, sit in the parking lot for 5 hours and counting cars and traffic, into and out of the store. So I would say footprint is one, and store performance obviously is another. Branson, do you have any other thoughts that you like to look at?
No, I think that's just essentially it. If the buildings sometimes I guess, a lot of the concern we get is, oh, if I see so many vacant dollar stores, and reality, as far as Dollar General goes, I don't think there are that many that are vacant. But that's going back to Matt's point about footprint and year built. It's important to look at those things, because sometimes if the stores are really thriving and succeeding, Dollar General will build a new, larger footprint store nearby to help continue to grow their sales. And so there are, several things to watch for and be careful about. But I guess all the buyers should know out there, if they knew if they were going to extend or not, the sellers would go ahead and extend the lease, and it would be much more expensive. So can avoid the, can I buy this at a 9 cap and make it contingent upon the seller adding, 5 or 10 years to the lease types of questions.
Right. Matt, why do I feel like you've spent a day or two doing that parking lot car count before?
Hey, you got to get your feet wet somehow. And man, it's one of the things we try to do we have several different types of clients, as Branson mentioned. And typically the clients who are pursuing the double net older stores are folks who are willing to, get their hands dirty and, work on things or getting contractors out to things. So when you're helping a client underwrite those deals, it is really important to visit sites and get out there, versus the triple net ones, where we have several clients for those who they never, put eyes on a property. They look at it through a Google map or just want a demographic report run. But yeah, I've spent my fair share, buying bottles of water in Dollar General stores and trying to get, as much info from a manager as I can to check viability.
Oh yeah, I've done the manager squeeze before on the broker side of things when I was a Marcus agent back in the day. Fun stuff. So we've got a lot of really great questions here, and I kind of want to dig into a couple of them. Ravenir asks, did the rental rate stay the same when the double net leases changed to absolute triple net? Did you see a change in lease rate there when they started updating those leases?
I didn't. I don't think so. I think, over time, lease rates are, for the most part, based on build cost combined with, what Dollar General thinks is viable to pay at that location. And over time, as construction costs have got more expensive and we've had inflation and cost of goods have gone up, aka therefore Dollar General sales go up. Their rents have just increased year over year for the most part. But I would say, transitioning from 2007 through 2009, when they had their double net leases, and then 10-year double net leases and went to the 15-year double net, and then through 2010 and 11 transitioning into the triple net leases, I don't know that the annual base rent amount that they've agreed to really shifted or changed at all during those timeframes.
Got it. And this is 2 questions I'm going to ask together because they are related. So what is the percentage of Dollar Generals that have renewed the lease after their initial term period? And, another question onto that is, do you know average sale performance of each store? And then the other question is, what are the options for the landlord if the property goes dark? Is it easier to find a new tenant or to sell as dark? What are your thoughts there?
I'll answer a couple of those and I'll let you jump.
You're going to pick the easy one, I bet.
So I'm trying to remember. It was like the second or third one. Can you?
Yeah. So what's the percentage of Dollar Generals that have renewed their lease, and then average store sales?
Okay. Yeah, the average store sales I think you can get by just looking at, since they're a publicly traded company, looking at their revenue and their number of locations. I think it's around mil six plus per store on average. And then as far as re-tenanting them or selling them as vacant, that is a case by case scenario. 100% depends on the location and how viable it is and how many other tenants are looking to be at the area versus what you bought it for. A lot of a lot of things to weigh in that scenario. So I don't know that I have a specific answer to that. I'll let Matt take the percent renewal question.
Yeah. So I wouldn't say I've got the actual percentage number of how many renew. What I will say is, we've sold over $500 generals, and furthermore just work with a lot of people who own Dollar Generals, who sell Dollar Generals. And I would say there's a difference between a store that just goes dark because it was underperforming and a store that was doing so well that Dollar General decided to relocate it to accommodate for more sales volume. So just kind of anecdotally, I would say it would be less than 2 or 3% of the stores that we have transacted with buyers and sellers that are just dark, walk away from the store, kind of pack our bags and leave. And I would say maybe in the 5% range of stores that are relocating. I hate even throwing those numbers out just because I unfortunately don't have that data. But once again, we've sold enough of these to kind of know what that looks like. And it's very rare for them to just walk away from a location.
Right.
Just outright, unless it's just performing so poorly that it just doesn't make sense.
And Matt, it sounds to me like most of the risk there can be mitigated by really doing your homework on the front end when you're looking at and evaluating these properties to buy.
Yeah, I think that's one of the things we work. Once again, we have a lot of guys who specialize in double net, and I think that's what they do a really good job of. And that's one of the perks of working with guys who know Dollar Generals and who understand, what a strong performer looks like, what the current footprint looks like. I'm not going to say we can look at a store and say, oh yeah, they're renewing. That's easy. But I think we can say, hey, this one has a really good chance of staying here for the foreseeable future. Or on the contrary, hey, you know what, this one, there's a couple red flags that we see, and here they are. And I would maybe stay away from this one. But on that same token, we've been proven wrong with that. It's like, man, wish we would have helped this guy buy this store because they ended up renewing,
Right.
a year later. And on the, it's just kind of the risk versus the reward. And
Right.
can you take that risk? And, are you willing, do you have debt on the property where the bank's going to come calling if they leave? So just several factors to consider there.
And a great question here from Mark that really gets into strategy of investors, looking at these Dollar Generals. When is the best time to sell a Dollar General store if you were to sell and not sit on it? Also, what percentages would you say investors do or like to do typically? Meaning, would you say most Dollar General owners are buying it and holding it, or buying it with the intention of selling it, a couple of years later? What do you see in your experience?
I would say, Matt, feel free to chime in here, but I would say that I'm going to say 50% of the buyers that we work with that buy these deals, initially when we talk to them and they buy the deals, their intent is to hold it long term. And then the other half have the intention of selling maybe within 2 to 5 years. So a 2 to 5 year hold.
These are the triple net, Branson.
Yeah, these are the triple net. Yes, yeah, these are the new triple net deals. The problem with answering these questions is there are so many different investors out there, so many different styles and strategies, and so again, it varies greatly on how people like to play it. But yeah, that's regarding the triple nets. And then if you get over into the double net deals, it's a complete case by case basis. It depends on the intent of the investor, and then maybe how many years are on it when they initially buy it. So if they bought a double net deal with 3 years on it, and Dollar General exercises their option and they get a new 5-year lease and a 10% increase in rent, they've definitely increased the value of the property. So sometimes people like to capitalize on that, and other people just like to park their money and keep the cash flow, and they're happy they got a higher rent payments and they just keep collecting them. So yeah, varies.
Yeah. And then I would say to the question of when is the best time to sell, I would say now, right? In today's market, it's really good. We're seeing cap rates for double net and triple net that we've never seen before. But I would say outside of just how crazy the market is right now, overall, the best time to sell is right after you get a lease renewal, right after you get some sort of commitment from Dollar General to stay on the property. That's going to obviously alleviate some of the concerns from buyers who want to know if a store is performing. And then also with longer term, you're going to get a stronger cap rate from the sale side because you've got more term on it. So obviously,
and your rent's going to be increased.
Yeah, hopefully. So that's another good point is, oftentimes a landlord will reach out to Dollar General to get a lease renewed, and Dollar General will say, sure, we'll consider that, but we're not just going to, out of the kindness of our hearts, give you a lease renewal and a 10% increase. They're going to want something in return. So
I want to say he's probably speaking to that when people want early extensions. So if there's 3 years left on the lease, Dollar General says we don't have to make a decision for 3 years. So, we want some type of concession if we're willing to provide that commitment now.
Yeah.
But we also, again, if a buyer does their due diligence correctly, when they actually come up on the renewal, I see quite often they're paying the full increase depending on the investor and their how
willingness to play
hardball.
hardball.
Yeah, willingness to play hardball with Dollar General.
So we actually have a question from Nick that is right in this vein. Nick says, recently bought a Dollar General with a 15-year term. Have heard Dollar General tenant reps reach out years in advance to try to renegotiate renewal terms, pressing landlords for rent reductions. Is that true? What's your experience been?
I would say, go ahead, Branson.
Okay. I would say that I typically rarely would ever see anything reaching out earlier than with 5 years left on the lease. And the most typical time frame for them to reach out is with 1 to 3 years left on the lease. And most of the time, I don't think it's them asking for rent reductions, or they may propose a rent reduction, but oftentimes it's just keeping the rent flat and not taking in the 10% increase that's usually built into the options.
Yeah. I would say for that gentleman who asked a question, who just bought a 15-year lease, I wouldn't think he has anything to worry about for a long time. I don't think I've seen a new 15-year absolute lease get extended yet. I think some of the shorter ones right now are around 7 or 8 years. Maybe it's out there, but yeah, most of the time they're coming at you, like Branson said, when you're under 5 years left.
And if they are extended, which I think I recall one, but it's by maybe larger developers and people with stronger relationships and more on a multi-store level versus reaching out to a one-off owner that owns a new 15-year DG and trying to extend a lease. But
I would say if they are coming to you and you are an owner and the lease has 3+ years and they want to discuss a renewal and are asking for something, I would say that's a good sign. I don't typically see them reaching out to owners of really underperforming stores with 3 years. So if they are approaching you, I'd say that's a good sign for your store, that your store is doing well.
Nice. And a quick question from Jackson. Sorry if I missed this, but what's the average going in cap for new construction? And for anybody that missed any portion of this or joined us late, stick around, and there will be a recording of this. I can share a link with you. You can email me and request it. I'm happy to share it with you, and then you will get contact information for Matt and Branson before we end here. Matt, Branson, brand new construction. What are we looking at?
I would say pre-COVID, even through the first couple months of COVID, you were looking, just speaking in general, anywhere from maybe like a 7 in rural markets to sub-6 in solid states and densely populated markets. And then throughout COVID, as a lot of buyers have transitioned their focus to buying essential retailers and tenants that didn't ask for rent concessions or rent abatements during COVID, which Dollar General didn't. So a lot of REITs that we work with, and other buyers looked at their portfolio, after the first X amount of months of COVID and said, hey, these tenants just continued to pay rent, didn't ask for anything. And everyone's started to take, a lot of the REITs have taken a larger position in Dollar Generals as far as trying to acquire more. And then a lot of the private investors have transitioned their focus from other net lease assets to Dollar General. So now they've been eaten up and there is a lack of supply. And so cap rates at this time have greatly compressed and, maybe 75 basis points better than they were pre-COVID.
Yeah.
Wow.
And I would say that same thing for the double net stores. It hasn't just been the brand new 15-year stores that have compressed. We're seeing that same thing in the double net market as well across the board.
So and then just to reiterate, to directly answer his question, I think, if you can find a new 15-year DG right now at better than a 6.25 cap, which I know some still exist out there or become available, it's a good find. So that last comment. I cut you off, Matt. Do you have anything else?
No, that's good.
All right. Now we've got a considerable amount of questions here, so I want to just try to shotgun through as many of these as we can. How many corporate stores are owned, operated by Dollar General, and how many are leased to franchisees? Question from VJ.
All of them are corporate.
100% corporate, VJ. So talk a little bit about the guarantee there. We had another question, and because there's so many, it's getting buried here in this list. That corporate guarantee, what does that mean?
Just means that it's like a corporate bond. So if for any reason like that location didn't perform and Dollar General wanted to shut the doors at that site, they corporately guaranteed the lease on a new one for 15 years. So you're getting your rent payments for the full duration of the lease, no matter what, as long as Dollar General doesn't go bankrupt.
Got it. And can we talk quickly about this influx of demand for Dollar General and other single, tenant net leased properties? What does that mean for supply? I mean, it sounds like right now with, the really high demand for both essentially leased businesses and for Dollar General just as a tenant, not only being essentially an essential business, but also, pre-COVID, kind of insulated a little bit from Amazon as well on the retail side. What are you seeing in terms of how that's, affected cap rates for other products as well? I know, for example, casual dining, has seen somewhat of a shift and a decline in its desirability. Is that compounded with COVID as well? Can you talk a little bit about that?
Yeah, I would say with the casual dining piece, unfortunately, they've taken, I would say, the brunt of a lot of this from the single tenant net lease space. And I think part of it's just because people, every investor is also someone who eats out, and they know that with a lot of these regulations, they're having a hard time even going into these restaurants. And I think even pre-COVID, some of those kind of casual dinings were in a tough spot. You saw a lot of like the QSR restaurants doing very well, and then some of kind of the nicer, newer restaurants in cities doing very well, and then a lot of these tenants, kind of the Applebee's, Chili's, who are still great concepts, but kind of people tending to go one way or the other with those. And I think COVID really kind of hurt them from a net lease investment standpoint. Now, I think that should change once these restrictions get drawn off. But in that vein with the casual dining, we've had some guys on our team who have focused on those from an asset class and have just honestly had a hard time getting traction in that because people are very fearful. And oftentimes with those, you don't have the corporate backing of the lease. So you might have a, 4 or 5 unit operator who is kind of the one guaranteeing rent payments. So you don't get, the warm and fuzzies as you do from a $25 billion corporately backed lease like you would on a Dollar General. So that's just kind of the high level kind of.
Yeah, I would say simplistically, buyers got worried about casual dining and tenants being able to pay their rent. A lot of those tenants asked for rent abatements and concessions. And so they redirected their focus to essential retailers. And so their redirection, created a lack of buyers in that space, which drove up cap rates and then created a compression as they all refocused on essential retailers like Dollar General.
Right. And Walter Lang asks, has your team been involved with any of the newer urban Dollar General stores? Can you talk a little bit about that?
What was the name? I know the this, newer, and I'm just blanking on it.
He's got quotes around urban Dollar General stores. I think the question is, some newer construction in more densely populated markets.
Yeah, I don't remember exactly like what Dollar General sadly is calling the urban concept, but yes, if it's in a densely populated market, overall it's the same guarantee behind the lease, same lease, and it's just more retenantable, more desirable to investors, so they trade at substantially lower cap rates.
I think he might be referencing Dollar General came out recently with a potential new concept targeting extremely urban areas with new footprints. To my knowledge, I don't think any of those have been opened yet. I might be wrong, but I think that's what he'd be referencing in these extremely urban, like downtown markets, areas where they just historically have not gone before. I think that's something they came out recently with and stated.
Is it the Pop Shelf? I think I remember
that might have, yeah, and even different type of higher end clothing lines, just kind of targeting a different class. I believe that's what he's asking, and I don't think that any of those have been finished yet from a construction standpoint.
As a Dollar General owner, it must be exciting to see them kind of expanding into these other business lines, and watching the brand strengthen as they kind of consider and weigh, how they can penetrate the market in other avenues.
Yeah. I think they're always looking to grow and increase revenue, and tapping into different demographics is a good way to do it, and one that they're approaching now.
Yeah. Now, Cody here asks, it seems like there is a serious lack of supply of new triple net Dollar Generals on the market. Along with that, cap rates have been compressing on new triple net Dollar Generals. Do you think we are at a peak of cap rate compression? If do you think cap rates will rebound?
Yeah, I felt like we've been at a peak from the compression every week for the past, 8 weeks. And I've been, surprised every week of kind of what we're seeing. So
yeah,
I don't know.
I wish we had a crystal ball, because I think even in previous years, we just continued to see Dollar General cap rates compress and more activity around them, and thought, this is going to be as good as it gets. I think that also throughout COVID, a lot of the developers' pipelines, the municipality shutting down throughout COVID, stalled permits. And although I still think Dollar General will come online with a substantial amount of new stores in 2021, there will be slightly less than projected. And given that there's already been an increased demand, and a lot of the developers we know have already pre-sold inventory through Q1 of 2021. So that inventory is already committed, and then there's going to be slightly less for 2021. I would predict that it stay the same or continue to compress even more if I were to take a guess at it.
Yeah.
So you hear that? Now's the time to buy.
Or sell.
Yeah. I mean, you're looking good either way right now. And Michael, there will be a recording of this for anybody that missed any part of this. There will be a recording. You can email me and I will send you a link I've put my email address in the chat. It's Yannis, Yannis, at Crexi.com. Branson, you got a lot of fans for the goatee. We got Eric Norgard saying, Branson, can you give us some advice on how to grow such robust facial hair? We got Landon in there.
See how sparse it is?
Is your ability to move
really
Dollar General inventory across the country augmented by that fantastic goatee? Landon wants to know. Yeah, I mean,
I'm glad we got some fans.
we gotta figure this out, man. You closed a lot of them. It's got to be something. I'm betting it is the goatee.
We'll see how this month goes, and then I'll have to circle back with everyone.
Troy's got an interesting question on timing. Is there a particular quarter that Dollar General likes to take delivery of new stores, or have you noticed a trend there?
That's tough because their calendar year, Dollar General's year, is not a typical calendar year, if I remember correctly. And so I do know that for reporting stock wise, they like to hit their quarterly numbers. So if they have the ability to, they like to try and push stores deliverable slightly sooner so that they can just hit their quarterly numbers and be able to report that to shareholders. But as far as like a specific quarter or something of that nature, I don't know that I'm aware of anything that they particularly target. You, Matt?
No, I would agree. I think kind of the influx of stores has been kind of rolls in, on equal parts, different quarters. So yeah, I don't think there's a specific time of year where you see more inventory. Maybe in the past you would maybe see more availability in the end of the year just because people weren't trying to buy things, during the holiday time. But I think that has gone away completely this year.
Right. And we've got still a pile of questions, and I'm sorry for everybody that we can't get to your questions, but Matt and Branson, if you two would please put your emails and contact in the chat, so these attendees can reach out to you afterwards. That'd be great because it seems like there is quite a few questions here. So this question coming in from Ravindir really is focused on the difference between the dollar stores. So is it that Dollar General in particular does well in comparison to other similar stores like Dollar Tree, Family Dollar? What's the difference between a Dollar General and other stores like Dollar Tree?
I would say, my best analogy is what's the difference between Walgreens and CVS. So as far as, Dollar Tree specifically is a different model where everything in the store's $1 or less. And so, they have a different concept. And I would say between Family Dollar and Dollar Tree, from the investors we visit with, most people think that Dollar Trees perform a little better and they have a better eye in the view of investors as the, I guess, general sentiment that I hear. But between Family Dollar and Dollar General, yeah, it's Walgreens and CVS. So as far as what they sell and their product lines, I'd say that, they're very equal, and they're very equal in the demographics they target. As far as which companies run better in performance, I would just point to, I guess, their stocks and what shareholders are saying and reporters are saying on which companies performing better and being managed better.
Yeah, and I would also say right now, Family Dollar is not building any triple net leases, nor Dollar Tree. So you really, the main difference from an investor standpoint is in their leases. Their product type obviously is different to Dollar Tree, being the everything for $1, Dollar Tree targeting kind of different markets as well. But yeah, just across the board, I think one of the main reasons why, I guess you could say Dollar General from a net lease standpoint has performed better is, I think, strictly just because of the way their leases are structured.
Nice. Now, Bill Fuller asks, when, if do you see store growth slowing? Or is that even on the horizon as far as you can tell?
I would say, Dollar General's fortunate in that they do target the smaller, more rural areas of America, and so they have more room to expand and grow in than many other tenants, that can't perform in the same spots and demographics that Dollar General does. So they still have a lot of room for expansion. How long they can keep it up, not really sure. Maybe because last year they did about 1,000 new stores. They're attempting to do that again this year in 2021, and so.
Well, they're expanding their footprint. I know I live here in Colorado, and they just recently came into Colorado from a new development standpoint. I don't think they're in Montana, so there's still kind of that Northwest territory that they're just getting into. So I think even the areas that they're already in, like Texas, for example, it's probably one of their biggest states from a store count standpoint. There's still a lot of Texas left where they could put stores down. And I think there's still a lot of areas just in general where they could go. So, we don't have the developer, knowledge of their plans, but yeah, I would agree and say from what we can tell, it's not slowing down anytime soon.
Yeah, I would say it is hard to see it, 3 to 5 years from now continuing at the same pace, but who knows?
Right. I mean, the same could have been said for Amazon a long time ago, right?
Right.
Yeah, they can't possibly keep growing, right? Boy. Okay, we'll get a couple more of these out here, and then we will wrap it up. Let's see who's got a good one. How about some do's and don'ts as far as picking locations? What are you looking for, Branson? If you're buying a Dollar General for yourself, what are the first couple things on your checklist that you are checking for?
I think, depends on your strategy and goals as an investor. So, do you want to chase yields? Do you want to be able to kick your feet up and not have to do anything? How
about this? Your goal is to not lose your shirt.
Well, there are many ways I think to do that. So in general, I don't see a lot of pricing difference between dollar stores that maybe like 15 to 13 years left on the lease. So some guys will buy them for a couple of years, sell with 13 years, and you have your cost of sell being brokerage commission, title, and other expenses. So you could lose a little bit there moving in and out. Also, as the market continues to compress like it has, that you can also make a substantial amount of money. But yeah, if you're looking for safety, you can go buy in a rural market and get a higher yield and know you've got 15 years of guaranteed income, and maybe visit the store every couple of years to make sure it's performing, so you feel like they're going to continue to stay, and that you don't need to worry about that if you feel like they're underperforming. After checking in every couple of years, maybe you sell it with 10 years left on the lease just to hedge your risk and let some other investor buy the deal. If you're looking at older double net stores, same thing. You can buy stores in denser areas that you can feel safe that you can always re-tenant, and you'll typically have to pay a lower cap rate, a little bit of premium for them, or you can just chase the higher yield in more rural markets, knowing the tenant's doing well and that they're going to continue to stay for X amount of years, and you can just keep clipping off your rent checks at a higher overall yield. So it's just a super tough question to answer.
Yeah.
Right.
A lot of fun ways to do it.
I think a lot of people believe that, Dollar General strategy is just to throw a dart at, an open space, and as long as there's enough land, they can build a store. And I mean, that's obviously not the case. That there's a lot that goes into site selection. And I think there's value in the rural markets. And I think if you were to be able to look at the sales for stores across the board, you would find that the rural markets, I would say, don't even underperform, and oftentimes probably outperform a lot of the more urban markets. And I think the easiest thing to say is there's lack of competition. So I would say don't be shy of the rural markets just because there's not a lot around. Dollar General does a lot of homework, and their developers and their site teams know what to look for. And obviously, with how well their company's doing, they've got that science down pretty strong.
Yeah, and to add on to that, 70% of their stores, I believe, are in rural markets, and they have over 16,000 locations. So they have a lot of data saying stores that sit here perform this way with these demographics. So they're able to make very educated choices as to where to put their new stores and how they'll perform.
Yeah, I mean, they got their size because they've been paying attention to the numbers. On that thread, Sam wants to know, are there opportunities for building new construction to Dollar General? Where do we start if you want to develop for Dollar General?
I would say that Dollar General has very strong relationships with developers that have been building for them for years across the country. And so that's a tough nut to crack. But there are developers building 100+ stores for Dollar General that have been doing that, or even 20 to 50 stores a year that have been doing it for 5 to 10 years, and they've, I guess the developers are fulfilling all of Dollar General's existing needs. Mm-hmm. So I would say your likelihood of being able to break in is very, very slim. And the only way that you could potentially do that is to have a site that they really want, and that you own, that you would just say, well, you have to use me if you want this site. But outside of that, you got, just good luck is all I have to say.
Got it. All right. Well, Sam, if you do manage to crack that nut, go ahead.
Let us know.
Yeah, email Branson.
We'll sell them for you. Yeah.
I'm gonna go ahead and we've got a lot of questions here, but I've put your emails in the chat here. If anybody has a question directly for Matt or Branson, their emails are in the chat. You've got Matt at trinityreis.com and b.blackburn@trinityreis.com. You can reach out to them individually with any questions that you have. Also, if you missed this or any part of this presentation and you'd like the recording, please send me an email requesting it, Yannis, YANNIS, @crexi.com, and I'll be happy to get you that link in a day or two when that is posted to our YouTube page. And if you're not following us on YouTube, what are you doing? You can have all this stuff sent to you right away. You can get your notifications there as well. But seriously, Matt, Branson, thank you so much for taking the time to come on and share with us, some of your wisdom on Dollar General and what you're seeing in the marketplace. It's certainly a very important topic right now, especially with everything that's happening, and as evidenced by our turnout and the many questions we received. Something that a lot of investors find valuable. So thanks so much for your time and sharing your expertise.
Yeah, thanks for having us, Giannis. Appreciate you guys and Crexi and all you're doing.
Absolutely. And thank you to everybody that took the time to come and watch Pro Perspective this week. I'm your host, Giannis Papadakis. We will be back again next week with, I don't know yet, but we will find out. And I'm sure you'll get an email from us. Take care, everybody, and see you next week.